Um, there's certain tail risks that can happen with the longer duration assets. I mean, if the market, especially the next inflation cycle, if the market perceives that the Fed's kind of given up on their inflation fight, and they expect longer inflation, like basically higher inflation for longer, some of those long duration yields could actually have an upward move. I don't really expect that right away, but it's something I'd be concerned about. I still think that long duration bonds are basically going to give you a lot of volatility without a lot of returns this decade.
Hmm.
And so, a trader could make use of them, but I'd be pretty careful with them. Um, again, I don't know if the Fed's going to try to push through another 25 basis point hike or not. I try not to be, um, too sure around what they're going to do on the margins, because it kind of comes down to one person's decision, and I haven't met the guy. So,
Right.
like, I can only kind of look at what market's pricing. I can look at what some of the ramifications are if they try to keep raising. I also see disinflationary pressures in the intermediate term, which gives them, reason to remain tight to varying degrees, but not necessarily reasons to keep tightening. And so I think Powell's incentives are aligned with kind of a pause and see here. Displays, you can display all sorts of different information with it. That one actually shows the Bitcoin block height. So it basically shows the time chain adding new blocks over time, which I
Oh,
find
fascinating.
unique. That it's from a company called CoinKite, and I know the founder of it, so he sent me that as like so I kind of keep it there to give him a shout out.
Cool. All right. Well, look, yeah.
Yeah.
So we just gave him a little advertisement there, but that's
There was
awesome.
a funny meme where Jack Dorsey had one of those behind him, the founder of Twitter and Square,
Yeah.
and he was giving an interview, and he had one of those behind him, and it showed, I think, how many. So a fraction of a Bitcoin is called a sat, and it showed how many sats were like for the dollar, and at the time it was something like 2,000, and people were trying to figure out what that number was, and someone was like, "Is it Moscow time? What number is there?" And so it kind of came like a meme in the space. But yeah, it's when you see kind of clocks like that, it's basically generally in the Bitcoin space. It's kind of like this way of displaying information.
All right. Well, I can't wait to see the first Lyn Alden meme from this video with the clock behind you and whatever it's reading in the screenshot that they use for the meme. Well, thanks for explaining that. It's really interesting. Nation's bills by draining the Treasury account, and this is to the tunes of hundreds of billions of dollars, and that's partially likely why we found a bottom in October of last year, and the markets have been supported now. She's basically saying, look, at some point, with very high probability, we know that debt ceiling is going to get raised. And once it does, she's going to have to then revert and start trying to refill the TGA by issuing a lot of treasuries. And that is going to basically turn off, that stealth stimulus spigot and tighten things further in the economy. So I'm curious what you think that means from a market standpoint. But I would imagine, okay, that's one of the few pillars that's been propping prices up right now. That looks like it's going to get removed soon. Perhaps as soon as they reach a deal on the debt ceiling.
Yeah, let me respond to that and perhaps mention a few other points in my notes. I too enjoyed Lyn's talk. She really knows her stuff when it comes to the economy and the Fed, and I know she knows quite a bit about the crypto space as well. But just further to some details about this, as she talks about the economy being at stall speed, and anyone that's ever been a pilot or trained to be a pilot, that stall speed is a very critical. And the things that we like to do, like covered calls, you can sell covered calls. It's still a bullish strategy, but with the belt and suspenders approach, you're trying to hit a lot of singles instead of home runs. Or moving to treasury bills, moving cash and or treasury bills out of cash and into the market at opportune times. So the words that she used in her prediction of what she thinks could happen in the market was sideways, grindy, choppy. Maybe. I still think there's a big downside elevator drop risk. It's kind of maddening and test your patience to watch the market here trading at the same level roughly that it was last May. So almost a full year, plus or minus a few hundred S&P points. And so the market has just really not made much downside progress, and it's been choppy all over the place. So the temptation is to think that it might continue that way, and it might. All of which is to say that a more active management style is probably what you want to do. If you want to be passive, I'd be passive in treasury bills, frankly. You know, the 6-month Treasury bill is roughly 4.5%. Reduce risk, get out of the market to a large extent, passively sit back in Treasury bills, wait and see what happens. There's going to be plenty of opportunity later to be aggressive.
Are now starting to uninvert. And in fact, the 5/10s spread actually did fully uninvert last week. It's now inverted again, but not nearly where it was. So this is sort of what you guys and a lot of the people on the channel have been warning about, which is, you know, when yield curves invert, that suggests that recession is going to happen at some point in the future. But once they've inverted and then they start to uninvert, that gives you a sense that, like, okay, the game is on, the fuse is lit, a recession's now, you know, likely on its way, you know, pretty soon at this point. So we are beginning to see that uninversion process in an increasing number of yield curves here. In addition to inverting yield curves, what Goodluck predicts here is that the Fed is going to pivot, and it's going to be cutting rates at least a couple of times this year. So, you know, he sees recession, pivot, and here's his parting quote that I just want to get your reaction to, John. He says that the markets are becoming more volatile, especially the bond markets, and he says the markets are so volatile,
quicker than they imagined. And then the psychology starts to work in reverse. You know, if folks were inclined to get a little bit more conservative, their mind starts to say, well, I can't sell now because things drop too far too fast. I'm going to wait for it to bounce a little bit to kind of get back to at least recover some of my quote unquote losses that I incurred for not selling when I thought I should. And the problem with that is oftentimes when there is that sea change of a kind of environment, you never get that balance, or at least not the balance that you mentally put in your head as to your next opportunity to get out. And that's exactly what causes major bubble bottoms to be situations where people are fighting each other to get out at the bottom, not near the top, but at the very bottom. And that's just all a very vicious psychological cycle that can oftentimes be compounded by these elevator type drops. As to the Fed likely reducing rates later this year, we have no idea. I think that the takeaway we probably have is that they're not going to do it until something truly breaks, and maybe we're nearer to that precipice than we were. Slow down the quantitative tightening because the system is breaking. Issuing more long-term debt isn't helpful to do that. So they may be forced to issue shorter-term Treasury bills, which floods the supplies, you know, puts the upward pressure on short-term yields, but it also is a very not necessarily prudent long-term fiscal situation to be financing debt at very short-term rates. And this kind of leads to the whole point that Lyn made, you know, looking at, for example, EPD and the pipeline sector. Contrary to the banking situation, which banks at their heart basically borrow short. When depositors put money in a bank, it's the bank essentially borrowing short term and lending long term, whether it's a portfolio of real estate loans or business growth loans or purchasing long term Treasury or agency bonds. Those are all borrowing short, lending long. What Lyn highlighted is, you know, perhaps we should be looking at sectors or companies that have done the opposite, where they've borrowed long, locked in historically low interest rates, and then they have a very sound, low-cost capital structure to underlie a very sound real asset that has long-term profit, income-generating potential. That's